out of the banks, it's just CBA that would be reporting their first half result at this point. They'll be reporting on the 10th of Feb. The other three major banks will be reporting their quarterly trading updates for the December quarter. That will be on the 16th, 17th and 18th of Feb. So just leading into that, hopefully you'll find the sector report insightful and helpful to position yourself before these reporting dates. Now, the key point that I really want to talk about right now is asset quality. Now, you've heard me say many times for many months now that I've been much more optimistic than the street on the outlook for asset quality. That remains the case, despite consensus bad debt charges coming down significantly over the last three or 4 months. In fact, for FY21, I think for every major bank, I've still got the most optimistic bad debt charge on the street. Now, if you take a look at that table that's just on the slide there, what you'll see is in the first column that's showing my bad debt charge forecasts on a 3-year cumulative basis, and the second column is showing consensus. So you can see consensus is still sitting above where I am in terms of bad debts. Having said that, so despite me being the most optimistic on the street, I'm actually seeing upside risk to my numbers. So I think my bad debt charge forecasts are looking increasingly conservative given the way the macroeconomics are playing out. So unemployment and house prices in particular are faring better than the bank's provisioning assumptions. And I think there's potential for positive revisions to those macro assumptions. And so that creates potential for provision release, even as recently, and that can happen as early as this month for the December quarter. So I think there's potential there for a release, and that's what's creating upside risk to my numbers. Now, practically speaking, I think the banks will choose to be conservative over coming months. So they may not choose to release provisions right now, but nonetheless, I think there's an increasing likelihood that bad debt charges will be quite minimal. So even if they're not releasing, and if they don't have to top up materially their provisions, then we can have bad debts close to zero, right? So there's quite a bit of an upside risk here. Now, just on the next slide, the last two columns there really show what would happen, what the earnings upside would be if provisions are released. So firstly, if you start with the last column is showing that at the moment, my bad debt forecast for FY21 are between 12 and 18% of FY21 earnings. So if the bad debt charges end up being zero for FY21, then that's the upside to earnings, 12 to 18%. And if there's any releases on top of that, it can potentially be another 5 to 15% on top of that. The way I've calculated the releases there is I've assumed if the banks apply 100% weighting to their last disclosed base case assumptions, because at the moment their provisions are a blended probability weight of their base case and downside case largely, with a small weighting to their upside case. But if they put all of the weighting in, all of the probability weighting into their base case, and the base case, by the way, is looking conservative already, as I've mentioned, because unemployment and house prices have been faring better than the base case assumptions. If they were to put 100% probability on that base case, there's further earnings upside of between 5 and 15%. So the real point I'm highlighting here is, despite me being the most optimistic on the street, I'm seeing upside risk to my earnings and dividends forecasts, and so there's even more upside to consensus on that basis. The ranking remains Westpac preferred, CBA least, and this is the second main point I want to make now. So I think what will happen is if things play out the way I'm thinking, and if the upcoming round of reporting shows that asset quality is faring much better than consensus expectations, then I expect, obviously, investor confidence to increase in the asset quality outlook, capital management outlook, and the dividend outlook of the banks. As that happens, I think the sector will become less neglected than it has been over the last kind of 7 or 8 months since the pandemic kicked in. Because the sector has been a bit neglected, and because many investors haven't wanted to be naked the sector, I think they've just been at a very high level, just been buying up CBA. So buying CBA has given them exposure to the banks. It's the largest bank in the index. And it's got the lowest risk profile. I actually do think it's got the lowest risk profile, and I think the common perception is it has the lowest risk profile. So it's been the safest bet, and it's made sense from that perspective in a period where people are placing more weightings to risk profiles, particularly in the bank sector. But as the confidence improves, I think the weighting that investors place to risk profiles will normalise and more attention will be given to relative valuation between the banks. And so I think it's important to note that right now, CBA is trading on a price to NTA multiple of about 60, price to NTA multiple premium of about 60% to Westpac. That's a pretty massive premium. And I think it's for me, I really cannot justify that any way I look at it. So right now, I would really struggle to justify a premium of anything more than 20%. Realistically, I think CBA should be commanding a premium of 10% to Westpac right now. The reasons being that both CBA and Westpac, they've got their loan book compositions are pretty similar. They're both skewed towards Australian home lending. They've both got about 62 or 63% of their books in Aussie home lending, which is defensive lending, and that's what makes them relatively good profiles compared to ANZ and NAB. Also, Westpac and CBA are delivering very similar underlying return on tangible equities at this point in time. And although CBA's got a better risk profile, I don't think Westpac's too far behind. And so putting all of that together and even putting together the differences in the capital position. So I'm taking into account that CBA does have potential for, off-market buybacks of up to 7 billion, possibly a little bit more over the next 3 years. Even after adjusting for all of that, I find CBA trading at a 60% premium, and I think that's very much unjustified. I think that's really just coming from pricing inefficiency at this point in time. So I expect that valuation gap to narrow. I do expect Westpac to rise and CBA to come back. Out of those two, legs, Westpac going up, CBA coming down, I think there's a greater probability of Westpac going up than CBA coming down, at least in the near term, because, as you heard me say earlier, I'm seeing earnings upside risk across the board. So in terms of earnings, I'm seeing upside risk to CBA as well, but CBA is for me worrying on a valuation basis. The next slide, if you just quickly take a look at the middle block there, the last row of the middle block, that will show you the div yields. And again, I want to focus on CBA and Westpac. CBA currently offering a FY21 div yield on my numbers of 3.5%, Westpac 5.7%. So that would also equate to a premium of just under 60%. So even on that basis, CBA is looking quite expensive. And I think what will happen is as investor confidence increases in the dividend outlook, there will be more attention given to the difference between the dividend yields. I think for the moment, investors have been happy with that lower dividend yield because it's deemed to be safer. But as the confidence improves about the outlook for the banks, I think money will start flowing into the higher dividend yielding banks. And very lastly, so some of you might be thinking, well, okay, CBA is trading on a 60% premium right now, but where has it been historically? Has this always been the case? What I want to show with this slide here is, if you take a look historically, and you've heard me say this many times, CBA has historically delivered a return on tangible equity premium to the other major banks. So historically, and this goes back to 2002, this chart, you can see it's pretty much always delivered a higher ROTE, but that gap over the other banks used to be much higher if you go back towards the early 2000s, and it's been closing since then. So if we go to the early 2000s, a much higher price to NTA and PE premium was definitely justified there because, empirically and mathematically, that would be justified given the higher ROTE that CBA was producing. But over time, you can see, that gap has narrowed. And we're at the point now where I think on an underlying basis, as you heard me say, CBA and Westpac are delivering very similar ROTEs. So there shouldn't be too much of a pricing premium between CBA and Westpac.